This is Heard Business School, where we sit down with private practice owners and industry experts to learn about the business of therapy together. I'm your host, Michael Fulwiler. Money management is a core skill in running any prosperous business, but it can be a maze of rules and deadlines, especially for independent practitioners. On this Office Hours episode of Heard Business School, we get into the tactics of quarterly taxes with my boss, Heard co-founder and CEO Andrew Riesen. He's a tax guru, a seasoned advisor, and an extraordinary guide for therapists trying to navigate the complexities of their finances. His depth of knowledge comes from years of experience assisting countless business owners in keeping the IRS at bay while their businesses thrive. In our conversation, Andrew demystifies the art of quarterly taxes, including who needs to pay them, when to pay, how to pay, and how much to pay. We dive into the practical steps needed from keeping accurate financial records to understanding the importance of true-up estimates. He shares insights on managing tax payments across multiple states and nuanced tax dynamics for S corporations, sole proprietorships, and self-employed therapists. Andrew also provides valuable advice for those just beginning their practices, emphasizing the significance of good bookkeeping and strategic planning. Here's my chat with Heard CEO, Andrew Riesen. Enjoy. Andrew Riesen, welcome to Office Hours.
Thank you for having me, Mr. Fulwiler.
Thanks for coming on the show. We really appreciate you making time. Thank you also for funding the show.
Yeah, I'm so busy, Mike. There was no way I was going to be able to make it work. No, I'm excited. This has been a long time coming, so it's fun to get on here and jam with you.
Absolutely. Today we're going to get super tactical about quarterly taxes, which is a topic of confusion for a lot of therapists, especially when they're first starting out in private practice. Can you explain just in really simple language what quarterly taxes are?
I will do my best to explain in very simple language what quarterly taxes are. When you have a W-2, let's say you're working for a hospital, you're working for an agency, you're working for a group practice, and they're giving you a W-2. What you get on your paycheck, what is removed from that is federal income tax, state income tax, your payroll taxes, and a part of the payroll taxes is Social Security, Medicare, unemployment taxes. And so when you have a W-2 job, all of that stuff is covered. But the minute that you become self-employed, so let's imagine, Michael, you're a therapist, you start seeing 5 cash pay clients on the side, you do nothing else besides just see those clients, all of a sudden, you are now responsible for covering taxes that you wouldn't otherwise have been paying. And so what that means is that Michael, the therapist, and Michael's therapy practice, because we don't have a better name for your therapy practice, is responsible now for paying federal income tax for yourself, state income tax, and then self-employment taxes. And self-employment taxes is basically, think about it synonymously with payroll taxes that you might be paying if you were paying into or if you were getting paid a W-2 rather. And so you're unfortunately responsible for covering the employer side and the employee side. And so unlike a W-2 where you just have an additional 7.5%, you have nearly 15.3% in additional taxes that you're paying in self-employment tax. Ergo, the fun of quarterly taxes for self-employed therapists.
Why does the IRS want you to make quarterly payments instead of having, you just pay at the end of the year when you file their taxes? Is there like a reason why the IRS needs that money during the year?
The reason that the IRS wants quarterly taxes to be paid in, businesses are responsible for payroll reports on a quarterly basis, on an annual basis. You're responsible for making those payments on a quarterly basis to cover that outstanding liability. And so the assumption that I'm going to go ahead and make here is that it is in lockstep or in alignment with the way that the IRS thinks about payroll reports from employers.
That makes sense. So they probably want your money during the year too, not just all at once at the end of the year. So who has to pay quarterly taxes? Is it everyone who is self-employed?
If you are self-employed and you are a sole proprietor, if you are an LLC, if you're a PLLC, if you're an S corporation, you are responsible for paying into a partnership as well. You're responsible for paying into quarterly taxes on a quarterly basis. That is because you are treated as what is called a disregarded entity, which means that you will file a Schedule C or a simple profit and loss on your personal tax return at the end of the year. And so you're responsible for covering the wages that you are earning against your individual income tax liability throughout the year. That is not being withheld against in a W-2 or a paycheck in an environment that you might have been in previously. Now, when you start to think about a C Corp, taxation gets a little bit different and it's treated differently because there's taxation as well at the business level. But all of those entities that I described, a sole proprietorship, an LLC, a PLLC, and an S corporation, they are all pass-through entities, meaning that all of the income that you earn in those businesses pass through back to you as the business owner.
That's a really great point. I think that is a source of confusion, right? Like if I'm operating as a sole proprietor or LLC, I'm generating income, it's going into my separate business bank account. Even if I don't take that money out of the business, I still have to report that as income, right? Like whether it's in my business account or I've transferred it to my personal account, it's still money that I made as a taxpayer. Is there like a cutoff where you're responsible for paying quarterly taxes, or does like everyone have to make quarterly tax payments?
It can be multifold. As an accountant would always say, it depends. But a good rule of thumb is that let's assume that your tax rate is 20% or 25%, baseline assumption. If you're earning over $4,000 or $5,000 in total income from your practice throughout the year, so that means from the clients that you see, in total, you earn $4,000 or $5,000. In all likelihood, you're going to surpass the threshold or the floor that the IRS has set for who is responsible for paying in on a quarterly basis. And that amount is $1,000. Now, I say it's multifold or multifaceted because it may be that you have a W-2 job, or it may be that your partner has a W-2 job and you're already withholding more than enough, so you don't actually need to pay in at that small of income, or of that level of income rather. And so always talk to a professional when you're trying to figure out how much that you might owe, but just know that the threshold and the floor of when you might owe is at $1,000 in your total tax liability. And you get to that by multiplying your tax rate, your effective tax rate, times that taxable income.
So you said if you expect to owe $1,000 or more in taxes annually, you're required to make these quarterly payments. Could you walk us through like how you would think about even calculating what that number is that you threw out, like $4,000, 20 to 25%? Could you just give us like a really simple example for someone who's trying to figure out like, I don't know if I'm going to owe $1,000 or more. Like, how would I even come to that number?
So the best way to calculate and understand if you're going to be above the floor of how much you might need to pay in from a quarterly taxes standpoint ultimately comes down to what I love to talk about, bookkeeping. You need to keep track of your income and expenses throughout the year and get a good sense throughout the year as to what does my total income look like, what do my expenses look like, and what's left over after expenses. That's what we multiply the tax rate against to help understand what our anticipated tax liability is. And so let's imagine, Michael, in Michael's therapy practice, you earned $10,000 for 2023. You had $2,000 of expenses. So you paid for simple practice, you paid for Psychology Today, you paid to be, to get your professional insurance, all of that good stuff. What was left over? So client sessions amounted to that $10,000. You had the $2,000 worth of expenses. What was left over after that was that $8,000. Against that $8,000, you multiply based on what your effective tax rate is. Again, talk to a professional about that. You can also look at your prior year tax return. There's calculators online, but multiply that by the $8,000. So what's left over after expenses, that'll give you a rough ballpark, of course, notwithstanding any additional deductions separate.
Something to clarify here too that I think is helpful is that these are called estimated payments, right? So it's not like you're getting a bill from the IRS every quarter that's telling, that would be nice, right? They told you how much to pay. You're not filing your taxes quarterly, right? You file your taxes annually, just once a year. These are estimated payments that you're making towards what your estimated tax liability is at the end of the year. Could you talk about when you have to pay quarterly taxes, like what the deadlines are?
So it's important to remember that there are tax deadlines throughout the year of which quarterly tax estimates are due. For quarter one, that is April 15th. Sometimes, again, I want to be very clear, sometimes these deadlines just shift on when these dates fall. But on a year over year basis, you can generally take into consideration that on April 15th, you'll pay for quarter one. On June 15th, I know it's very weird, that's just 2 months, you'll pay for quarter two. On September 15th, you'll pay for quarter three. And on January 15th, you'll pay for quarter four. And that last quarter of payments is when you would think about doing what is called a true up. So let's say you made quarterly tax estimate payments throughout the year and you were a little bit short or you a little bit over. So maybe you made consistent payments throughout the year. That's a good time to build in and make sure that you're at least covering 90% of this year's current tax liability. Otherwise, you might be at risk for penalties and fees or accrue interest because you've made underpayments throughout the year.
A couple of things there I just want to highlight. So the first quarter payment is due on April 15th, which is also when your annual taxes are due for the previous year as well, right? So I know for therapists who are in private practice for the first time, like that can be a big shock where you're like paying any outstanding tax liability from the previous year and on the same day, because the IRS doesn't want to spread it out for business owners. That's like due at the same time. Also, yeah, Q2 is only 2 months. Like that doesn't really make a lot of sense, but that's just the way that it is. And then you mentioned this, but if that deadline falls over a weekend, it's the following business day. So that's why you get, like, sometimes it's the 17th instead of the 15th. When you're estimating your quarterly taxes for, each of these deadlines, April 15th, June 15th, are you estimating them based on your income that you've earned during that time period, like within that quarter? Or are you thinking about your entire annual income and then you're just dividing it by 4?
Great question, Michael. Your tax prowess is becoming quite strong, I must say. So
Thank you.
In order to calculate how much you owe on a quarter over quarter basis for your quarterly taxes, there's 2 different approaches that you can take, and I would take both into consideration. So there's the safe harbor approach. And so if you're working with a local accountant or an accountant in your city, in all likelihood, you're going to file a return with them. If you're self-employed, you're going to file a return with them. They're going to come back to you with stubs for estimated payments that you should be making for the following year. Michael, I'm sure, given that you've been self-employed for a period of time, was that how it was for you when you worked with a local accountant?
Yep. Yeah, they asked me if my income was going to be the same or not next year, and then just estimated based on that, basically.
Exactly. And so that's the important thing to take into consideration, because my assumption is that there's a lot of early career therapists that are listening to this to learn about how to make quarterly tax payments. That approach can be very helpful if you have a stable practice, if you don't have income outside of your practice that is moving, because the important thing to take into consideration is that quarterly tax estimates are a representation of your full financial picture. And so you could earn $20,000 in your first year of practice and then $90,000 in the next year. And so the estimates that you received that are safe harbor estimates, so 100% or 110% of your prior year tax liability, may have been good if you made $20,000 again, but you may show up to tax time with a $15,000 tax bill that you hadn't thought about because you weren't prepared for the additional income that was increased. And so the second way to look at it is on a quarter over quarter basis, which is something that we do at Herd on top of the safe harbor estimates. Is your business is right here, right now. This is where we anticipate your business to be at the end of the year. Let's calculate a quarterly tax estimate based on where your business is anticipated to end, based on how it's growing. And so a more real-time perspective. And so you want to take 2 looks. You want to look at the safe harbor estimate, make sure that you're paying that baseline estimation that's been provided, but then you also want to look at how is my business changing over the course of the year? Am I setting aside based on where I'm actually at right now? And then I had alluded to the full financial picture. And so in calculating those quarterly tax estimates, we're not just talking about, Michael, your therapy practice and the income that you've earned in your therapy practice. We're talking about your W-2 job, your income that you're receiving from the 25 real estate rentals that you and your partner are selling, and also your partner's income, and your partner's earning, let's say, $500,000, right? And so you look at the practice that you have, and then you look at that broader picture. Your practice may look very different than the broader picture. And so a lot of folks will be like, oh, it's 30% or 25%. But the reality is the picture looks much different when you look at the full picture. And so make sure you look at the whole picture to understand how much to set aside.
I'm glad you brought up the safe harbor idea, because that's something I was going to ask you. When you think about, if I was in private practice last year, I can look at what I made. I can just pay, 100% of my previous year's tax liability in 4 equal payments. Like, that sounds very straightforward, right? But if it's my first year in practice, how do I know how much I'm going to make? Like, how do you think about that? Or how do you advise therapists when they're just getting started to project their income when they don't have any historical income?
So how do I know, if I am in my first year of practice, how to project the amount of income that I'm going to earn, and then kind of work back into how much I might potentially owe? So everybody here has probably used a Google Sheet before. That's going to be an assumption that I make. My recommendation to calculate this out is go to a Google Sheet and imagine when your practice is full, whether it's in 3 months or 6 months, how many clients am I going to be seeing and what am I going to be charging? It's imperfect. You're going to have, 10 to 15% of your clients that don't show up, that reschedule. But let's just look at it at the highest level possible. So let's imagine you're doing 10 client sessions a week at $150 per session. Let's assume then you're going to earn $6,000 a month. And so that would be $72,000 for the year. And so from that $72,000, we can then calculate, okay, this is how much I should think about setting aside when I am at $72,000. Now we have to take into consideration the first quarter and the second quarter. The first quarter, it may be half of that, or it may be even a quarter of that. The second quarter, it may be half of that or 3/4 of that. So there is a ramp up time. And the thing that we see typically with providers that are moving into private practice is it's about 6 to 9 months till you hit your full caseload and hit a full stride to where you have a wait list. So when a client leaves, they're coming back over. And so I would figure out how to take some percentage to reduce that, because it's probably not $72,000 that first year, but do the math based on sessions that you're going to see, amount that you're going to charge. And then from there, you can use a tax calculator online or talk to an accounting professional. And we would love to help you calculate how much you might need to think about setting aside. But definitely think through what your business is going to look like. And there's really simple ways to back into that from a calculation standpoint.
Are you saying that each quarter you can recalculate your estimate as well?
Yeah. So every quarter, let's imagine that you have a growing business. You should definitely be thinking about recalculating your quarterly tax estimate, right? So in Michael's therapy practice, which is just the thread that's going through this entire conversation, his first quarter was 5 clients that he was seeing. His second quarter was 10 clients that he was seeing. And so let's say that first quarter in Michael's therapy practice, you earned $5,000. And so the total income that you might anticipate earning for that year, $20,000. But in the second quarter, you earned $10,000, right? And so then you look at halfway through the year, you've earned $15,000. So you might anticipate that you're going to earn $30,000 or $35,000. And so think about how your income is going to grow and then calculate based on that growing income. One thing to note is that what often happens in your first year of practice when it's growing is that your liability in the third and fourth quarter is going to be a lot more than in the first and the second quarter. So just know that that is very normal. It will stabilize over time once you reach a practice that you feel great about, but it will take time to get there. And so set aside money so you don't have surprises at the end of the year.
Let's also acknowledge that as your business grows and you owe more in taxes, it also means that you're making more money, which is a good thing. I think that's a helpful reframe for folks like, oh my gosh, I owe so much in taxes. Well, your business is doing really well. It's a good thing. There's ways you can reduce your tax liability, which is a separate conversation. But I think that's a net positive, right? It means your business is doing well. You're making good money, which is why your tax bill is going up too.
Yes, as we like to say in the workshops that we do, Mike, when you have maximized the amount of savings that you can find in your practice, mo money, mo problems. When you make enough money in your practice and you've done everything that you can to minimize the tax liability, it's great. Just celebrate the awesome year that you had in your private practice. But I can promise you that we will do some conversations around how to minimize that tax liability if you're feeling the hurt.
So just really tactically, how do you make these payments? We've talked about how to calculate them, when to pay them. How do you pay them?
The way that you go about making quarterly tax payments is it's multifold. So the one thing that government websites, whether it's the IRS or it's the state, do really well, minimal number of things that they do very well. The one thing that they do really well is direct payments. Whether you live in California and you're going to pay the franchise tax board the amount of income tax that you owe in California, or let's say you're an S Corp and you have the franchise tax associated with that, or going to the IRS website, most of these websites have a direct pay portal. Shameless plug for Herd. Michael and his amazing content team have put together a state-by-state resource and a federal resource that you can leverage that show you on a step-by-step basis how to go and make those direct payments. If you are like somebody that is more old school and you want to write up a check and mail that in, or you want to give it to the pigeon and have them fly it over to the IRS, you can certainly do that as well. But the IRS makes it pretty straightforward to go ahead and make those direct payments, as do most states. I will not claim that every state makes it easy, but most states do.
We'll drop that in the show notes, the link to that state-by-state guide for paying those state taxes. And then what happens if you get to a quarterly tax deadline? Say June 15th is the next one that's coming up here at the time of this recording, and you haven't been setting aside 25, 30% for taxes. You can't afford to make the estimated payment. What should you do in that situation?
If you get to a quarterly tax deadline and you are unable to make the payment, so let's say June 15th, because we have one coming up, Michael is listening to this podcast. He's, this is his first year in practice. He's already feeling really overwhelmed. He's, trying to figure out how to manage his clinical work. He's trying to figure out how to stay on top of his notes. He's learning how to get into the ebbs and flows of, client acquisition and marketing. There's so much going on. And, he didn't even think about setting aside money for quarterly taxes. Totally fine. That is okay. I want to create the space here to acknowledge that there's a lot you have to learn how to do as a business owner, especially as a clinician. I'm working with clients and managing all of that. If you're getting to the second quarter and this is your first year in private practice and you haven't been able to make the payment, or you forgot to set aside money, the best time to start is now. And if you can make in any payments or cover 100% of your prior tax liability or 110% as a baseline, awesome. From there, at least as a baseline, you'll make sure that you're avoiding any sort of underpayments and penalties. But from there, by the end of the year, your goal would just be to cover 90% of your tax liability. And so again, continuing throughout the course of the rest of the year, making some assumptions around how much I may make in total income, what my expenses are. This is what good bookkeeping enables you to do, is stay on top of what your income is and thus stay on top of how much you need to set aside, and just start that practice now. And it can be a spreadsheet. It certainly could be, bookkeeping software, could be using something like Herd to where somebody's going to help you get into the habit of tracking your income and expenses. And that's going to get you to a place where you have a clear understanding of where your business is at and thus how much to set aside. And if you don't have the money to work with an accountant, or, you don't have the money to go have a conversation with a tax preparer to help understand, again, 30 to 40% is a good baseline estimate. To be sure, it may not be the right number for you, but it is better than setting aside nothing.
Could you talk about that a little bit more? So the advice that we give to therapists is, if you can't afford to make the full payment, it's better to pay something than to pay nothing. Can you explain why that is?
So the reason that it's better to pay something instead of nothing is that the penalties, the fees, the interest, they accrue on the outstanding liability or the amount that hasn't been paid in throughout the year. And so the higher the amount of liability that hasn't been reduced by the estimated payments, the higher the penalties, the interest, et cetera, that you're going to see at the end of the year. Ultimately, you could talk to some accountants or tax professionals and they would say, just wait until the end of the year and eat the penalties and fees. It's pretty clear from the IRS what the codification and guidelines are as to who is responsible for making those payments. So trust who you would like, but make those payments ahead of the end of the year. When penalties and fees and interest really starts to accrue is after April 15th or the filing deadline. And so if you can't make any payments ahead of April 15th, just know that that April 15th deadline is where those penalties, the fees, the interest, that's really going to start to accrue on top of that.
When people hear penalties, interest, fees, it feels pretty scary. Can you put into context like how much that percentage is or what the penalty is if you don't pay or underpay?
Yeah, so the penalties and fees associated with underpayment or late payment go from about 0.5% up to 25%. It's based on your total tax liability, and so the more money that you earn, the more they will be, and the time frame or when you pay it obviously has a massive influence on how much they're going to be as well, right? Because if you don't make let's say you file an extension a tax extension at the end of the year because you were unable to make payments, and then you don't file anything until let's say June or July, and you haven't made any payments whatsoever, you're going to see some pretty steep fees. But if you go ahead and, file in the amount that you need to by April 15th or the tax deadline or what your total tax liability is, chances are that the penalties, the fees, the interest will be quite low, but you will still be responsible for paying them and they will still be influenced by your total tax liability.
When you're self-employed, you owe federal income tax, which is part of your estimated tax payments you're making. If you live in a state and practice in a state that has state income tax, you're responsible for paying into that as well. What happens if you're seeing clients virtually who live in other states? How do multi-state quarterly taxes work?
Multi-state quarterly taxes, especially in the age of telehealth driven by the pandemic and things like SIPACT and the Counseling Pact and all of these agreements at the licensure level of ease of ability to operate in multiple states. I want to be very clear. I am very, very in support of multi-state licensing and the ability to see folks in additional states. I think it's great, especially for states that don't have a high density of providers. But the reality is, from a tax standpoint, for tax nerds like us, this is an ever-changing thing that is kind of ever evolving. Like the big accounting firms are constantly talking about this concept of nexus. So what is the actual taxability event that has taken place in a given state? And so let's imagine, Mike, that you're in one state, you're seeing 10 of your clients, in another state, you're seeing 5 of the clients. Under the concept of nexus, every state has their own. There's a crossover of a number of different types of nexus, but every state has their own kind of rule of thumb as to what creates a taxability event. One state could be physical presence. So you might need to go to that state 4 times throughout the year. And then at that point, you're going to be responsible for paying taxes. Some states have economic thresholds. So you need to earn X amount of money in this state. Some states have source of income thresholds. So if the income is sourced in that state versus sourced in the state that you're operating from, you might owe taxes in that state. And so all of this to say, multi-state taxation is very complex. I would 100% talk to an accounting professional or a tax professional. Even if you are of the DIY, do-it-yourself varietal, have a conversation with a professional to get a baseline understanding of where you might owe taxes. Or this could come through the conversation with your accountant at the end of the year, and they could help you prepare for that. Certainly a complex topic. It's ever evolving. Hopefully there is some sort of consistency over time at the state level. Certain states have reciprocal agreements and other agreements in place that make it easier to manage this process, but it is taxing process.
Nice. The recommendation that we give folks as well is to contact their Secretary of State's office, right? Like typically there'll be a phone number or an email, you can contact, and someone should be able to tell you what kind of the unique nexus rules are in your state and provide some guidance. Are there other resources therapists could use?
So far as understanding if you owe tax in a given state, if you're operating in a given state, typically there is a Department of Finance or Department of Taxation that you can reach out to. The Secretary of State, Michael, to your point, is a great place to start as well, because they're going to help you understand if, based on your business and the way that you're operating, you need to perform a foreign state qualification or an out-of-state registration in that given state. And typically when you register your business in a given state is when you'll be subject to additional events within that given state or potential liabilities.
Yeah, I think we could have a whole separate conversation on multi-state quarterly taxes, but I think that's a helpful overview. Essentially, what I'm hearing you say is every state is different. Consult with a tax professional, reach out to your state kind of governing body as well for guidance. I want to talk about quarterly taxes for S Corps. So for folks who are listening or watching this on YouTube, if their business is taxed as an S Corp instead of a sole proprietorship, are they still responsible for paying quarterly taxes?
S Corps, despite what you might hear in your communities or Facebook groups, are still responsible for paying quarterly taxes. So when you become an S Corp, you become the owner of the business, an employee of the business. So the owner of the business earns income from the business. The employee of the business earns income in the business. And so the employee of the business will receive, you, in this example, Michael's therapy practice has now become an S Corp. The evolution of your practice throughout this conversation is fantastic. So Michael's therapy practice has now become an S Corp. And so Michael is responsible for paying himself a reasonable salary. Against that reasonable salary that he pays himself, he will pay federal income tax, state income tax, and payroll taxes as well. And the business will pay the other side of the payroll taxes. Again, think synonymously with self-employment taxes. What is left over of the income after the expenses in the practice and his wages is considered to be a tax-free dividend or a tax-free distribution. And so that tax-free dividend or that tax-free distribution, you are still responsible for paying federal income tax and state income tax. The savings in becoming an S Corp is that you're reducing or removing the self-employment tax on that tax-free dividend or that tax-free distribution. So that income that's left over in your S Corp that passes through back to you as the owner at the end of the year is treated differently from a tax perspective than traditional sole proprietorship or income that is derived from a disregarded entity. And so what that means is, yes, you still have to pay taxes. The rate of which you will apply against that total income is going to be much lower because you won't have that 15.3% as well.
Do you still make estimated tax payments at the same deadlines as an S Corp? Because I know S Corps have a different filing deadline, right? It's March 15th instead of April 15th, but are the estimated payment dates the same?
For your individual income tax liability that you accrue as the owner of an S corporation, you are responsible for making those payments on the same exact deadline schedule that you would as a sole proprietor. Again, why? Because this is your individual income tax liability. And so this relates to the income that you are individually earning. So the income that is passed through back to you. An S Corp, you are not taxed at the business level. Now, there are certain circumstances where certain states have a tax on the S Corp itself. California and New York as a couple of examples. That would be a franchise tax on the business that is separate from the individual income tax and the quarterly estimated tax payments that you're responsible for paying. So do get a sense of, am I in a state, if I am an S Corp, where I might have an additional tax levied against the business, but separate those two things, because individual income tax that you're earning, the income that you're earning from the S Corp, that's related to that total financial picture for you or you and your partner.
If you miss a deadline or underpay on your quarterly taxes, so say you were paying your prior year tax liability when you filed your tax return on April 15th. You just didn't have enough cash in the bank to make a payment for your first quarter estimated tax payment. Do you start accruing interest as of April 15th, or is it just when you go to file your taxes at the end of the year, if you've, underpaid during the year, then there's interest that you have to pay on that? Does that make sense?
So generally speaking, in the rules of the IRS or the codification, the guidance, as we would call it, it's like our big book that we look at to make ourselves feel important. You are generally responsible for making 4 quarterly installments. And so if you miss an installment or miss 2 installments, you will typically see penalties and fees start to accrue on top of that, or penalties start to accrue, underpayment penalties to be specific. However, if you do cover up to 90% or to 90% of your current year tax liability or 100% of your prior tax liability, it's unlikely you will be assessed penalties on your tax return at the end of the year. So best practice is to make those payments. The reality is that you may have uneven payments that you need to make throughout the year because you have a growing practice, or maybe you're going on paternity leave or maternity leave and taking time off. And so there's extenuating circumstances. And so best practice, make those payments on a quarterly basis. Try to cover 90% of current year or at least 100% of the prior year.
We've talked about underpayment or no payment. What happens if you overpay your quarterly taxes?
If you overpay your quarterly taxes, the IRS is keeping the money. No, I'm only kidding. So if you overpay your quarterly taxes, you will receive a refund at the end of the year. And so let's imagine that, Mike, you were a W-2. Well, Mike, you are a W-2. So this is not Michael's therapy practice. This is Michael in current state. Let's imagine Michael set up his withholdings, he over withheld at the end of the year. You're probably used to getting a refund. Same thing goes for estimated tax payments. And so Michael's therapy practice, he was very thoughtful and proactive and set aside 40%, but he really only needed to set aside 30% or 32%. And so he got a nice little bonus back at the end of the year in the order of, let's say, $2,000 for his therapy practice. And so what him and his partner did was immediately decide that they were going to take an awesome long weekend and celebrate the fact that they had a great year of their private practice.
It's a good problem to have. And also recognizing if you're, overpaying those estimated payments, it also cuts into your cash flow, right? So if you can avoid that. Nuanced question here, but it's something I did want to ask. This has come up in questions from the community at Herd. If I am a full-time W-2 employee, my employer is withholding, taxes from my paycheck, and I also have a part-time private practice. Can I have my employer just withhold more to cover this, these quarterly payments, or is it just 2 separate things that I need to be thinking about?
If you have a W-2 job, and let's say a full-time W-2 job, and then you're straddling building into a private practice on the side, which is a very common thing that we see while you're kind of working up the process or the caseload to move into a full-time practice. If you have a W-2 job, you can certainly withhold additional money on your paycheck to pay into federal income tax, state income tax, all of that good stuff. And so, yes, that is a process that some people do take to make sure that they're covering in the additional tax liability. Typically what we see with providers, it's easier to kind of like separate those 2 things, but everybody has their own process, and that process is totally fine. And the IRS has a worksheet. We can link it in the show notes that helps you understand if you do want to, Michael, in this example, go to your partner and have her increase withholdings on her W-2 on her job so that you can cover that outstanding liability.
There's a lot of nuance when it comes to figuring out how to pay quarterly taxes. Can you talk about how Herd helps therapists navigate this process?
There is a lot of nuance to learning how to pay quarterly taxes, especially when you have a growing practice, or especially when you have a full caseload and you're trying to manage all of this stuff. The way that Herd approaches it, so Herd, for context, of course, you know this, we support you with tracking your income and expenses throughout the year. We help you figure out how to pay yourself on a monthly basis and set aside money for taxes. And so month over month, we'll help you understand how much you should set aside. Every quarter, we'll provide you the safe harbor estimate, of course, from the prior year tax return, but also an up-to-date estimate or a real-time estimate to just get a good sense of, based on where you're at, what is the conservative amount that you should be paying. Ultimately, as a business owner or the therapist, you're responsible for making that judgment call. But at the end of the year, certainly as we work through quarterly tax payments, we'll add up all of those estimated tax payments and make sure that they're included on your tax return that we file for you or for you and your partner.
Well, thank you, Andrew, so much for coming on the show. This has been a very dense conversation, but very helpful. And, we'd love to have you back on soon.
Thanks so much for having me, Mike. I am ceaselessly amazed at how good your tax knowledge has become over our time of working together. And I hope this is helpful to the therapists that are out there. As always, give us feedback. We are looking to learn and grow.
Thanks for listening to this Office Hours episode of Herd Business School, brought to you by Herd, the financial back office for therapists. For downloadable tools and guides, visit our resource hub at joinherd.com. And don't forget to subscribe on YouTube, Apple, Spotify, or wherever you get your podcasts.